57,000 jobs. That's it. That's the whole June report. Economists were expecting somewhere north of 100,000. We got 57,000. And in a normal world, that number alone would be enough to get the Federal Reserve talking about cutting rates to save the economy. Instead, the head of the Federal Reserve just spent the last month talking about raising them. Sit with that for a second, because it doesn't make sense on the surface, and that's exactly the point. The labor market is visibly slowing down. Hiring in leisure and hospitality actually fell by over 60,000 jobs last month, and the government quietly revised April and May's numbers down by a combined 74,000 jobs, meaning the economy has been weaker for longer than anyone was willing to admit in real time. And yet, the people who control the cost of borrowing money in this country are not loosening up. They're talking about tightening further. So here's what's actually going on: why the Fed finds itself boxed into a corner it can't cut its way out of, and what it means for your money, your savings, and the three assets that are going to feel this the most: stocks, gold, and the dollar itself. Let's get into it. First, some basics, because I want everyone watching this to actually understand the mechanics here, not just feel vaguely anxious about it. The jobs report is basically a monthly checkup on the economy: how many people got hired, how many lost jobs, and what the unemployment rate did. Unemployment actually ticked down slightly to 4.2%, which sounds fine on its own, but that's happening at the same time job creation is stalling out, which is a weird, uncomfortable combination. It usually means people are dropping out of the labor force, rather than the job market actually being healthy. Then there's the interest rate, which is the price of borrowing money, set by the Federal Reserve. When the Fed raises rates, mortgages get more expensive, credit cards get more expensive, business loans get more expensive, and the whole economy slows down on purpose. It's how they fight inflation. When they cut rates, borrowing gets cheaper, and the economy gets a jolt of energy. Normally, weak jobs numbers push them toward cutting. That's the playbook everyone learned. Weak economy, lower rates, stimulate growth. Except that playbook assumes inflation isn't a problem. Right now, it is. And then there's the bond market, which I think is actually the most important piece of this whole story, and the one most people skip past. A bond is basically an IOU. The US government needs to borrow money to pay its bills, so it sells these IOUs to investors: banks, pension funds, foreign governments, regular people, promising to pay them back later with interest. The interest rate on those IOUs is called the yield. And right now, the yield on the 10-year Treasury bond, which is sort of the benchmark for borrowing costs across the entire economy, is sitting around 4.55 to 4.58%. That's elevated. That's the market telling the government, we don't fully trust that inflation is under control, so we want to be paid more to lend you money. So here's reason number one why the Fed is stuck. Inflation is not going away. It's actually got a new leg up. There's been military action involving Iran, tension across the Middle East, and that's putting upward pressure on oil prices. Energy is in almost everything. It's in the diesel that moves your groceries, the plastic in your phone, the electricity that powers the server this video is streaming from. When oil goes up, inflation doesn't stay contained to the gas pump. It leaks into everything downstream. Cutting rates into that kind of inflationary pressure is like pouring gasoline on a fire you're supposedly trying to put out. Reason number two: some of the biggest foreign buyers of US debt are pulling back. For decades, the US government relied on countries buying our treasury bonds in massive quantities to fund our spending cheaply. When your biggest customers start buying less, you have to offer a better deal to attract new buyers, meaning higher yields. And higher yields mean higher borrowing costs for literally everyone, from the federal government all the way down to your car loan. Reason number three, and this is the one people are sleeping on: there's a new Fed chair in the seat now, Kevin Warsh, who took over this year specifically because the president wanted someone who would push rates lower fast. That was the whole plan. Except Warsh's very first meeting in June didn't cut anything. The Fed held steady at 3.5 to 3.75%, and the committee's own internal projections, the so-called dot plot, showed exactly 0 members forecasting a cut for the rest of the year. Some are now openly floating hikes. Fed Governor Chris Waller, who, by the way, was one of the earliest and loudest voices pushing for rate cuts just a year ago, said in a recent speech, and I'm going to read this one directly because the wording matters: "I can no longer rule out rate hikes further down the road if inflation does not abate soon." That is a stunning reversal from a guy who was in the cut camp. When the doves start talking about hikes, that tells you the data behind closed doors is worse than what's showing up in the headlines. Reason number 4 is the one nobody wants to say out loud on cable news because it sounds too big to be real, but it's just math. The US government is currently sitting on close to $39 trillion in debt. Every percentage point that borrowing costs go up adds staggering amounts to what the government has to pay just in interest, not principal, just interest, every single year. That interest bill is now competing with everything else the government spends money on. And here's the trap. If the Fed cuts rates to relieve that pressure, inflation could reaccelerate, and bond investors, spooked by inflation, could demand even higher yields anyway, which pushes borrowing costs up regardless. Cut rates, bond market panics, yields rise, cost of borrowing rises. The exact thing you were trying to prevent happens anyway. There is no clean exit from that trap. It's why some analysts think the eventual solution ends up being some version of printing more money to cover the gap, which is its own long-term problem for the value of the dollar. All right, quick pause, because I promised you something at the top of this video and I want to deliver on it before we go further. If any of this is making you a little uneasy about how exposed your retirement savings are to a system this fragile, I put together a free guide specifically on protecting retirement accounts during exactly this kind of environment. Rising rates, sticky inflation, a bond market that isn't behaving the way it used to. It's free. There's a link below this video, or you can just scan the QR code if you're watching on your phone or a TV. No pressure, just information. Okay, back to it. Now let's zoom out, because this exact tension, a government that's overextended, an economy sending mixed signals, and a central bank cornered between inflation and growth, is not new. It's happened before, and looking at how it played out is genuinely the best way to understand where we might be headed. Go back to August 1971. Richard Nixon goes on television on a Sunday night and announces that the United States is closing the gold window, meaning the dollar would no longer be redeemable for gold at a fixed rate, a promise that had underpinned the entire global financial system since the end of World War II. Nixon framed it as a technical, temporary move. It was neater. What followed was a decade of stagflation, a brutal, confusing mix of high unemployment and high inflation happening at the same time, which conventional economics of that era said basically couldn't happen simultaneously. People who lived through the 1970s remember gas lines wrapping around blocks, grocery prices changing week to week, and a growing sense that the guardians of the economy had lost the plot. Gold, which had been fixed at $35 an ounce for decades, was suddenly floating freely, and by the end of that decade, it had risen more than 20-fold. Not because gold became magically more valuable, but because the dollar it was priced in became less trustworthy. Then came the fix, and this is historical parallel number 2. 1979, Paul Volcker takes over as Fed chair, with inflation running near 14%. Volcker did something that would be politically unthinkable today. He jacked interest rates up to nearly 20%. Not 2%, not 5%, 20%. Small businesses collapsed. Unemployment spiked into double digits. Volcker was so unpopular that farmers drove tractors to blockade the Federal Reserve building in Washington in protest. But it worked. Inflation eventually broke, and the foundation was laid for decades of relative stability afterward. The lesson from Volcker is brutal and simple. Killing embedded inflation requires the central bank to be willing to hurt the economy on purpose for a while to fix it permanently. The question hanging over the Fed right now is whether Kevin Warsh and this committee actually have that kind of stomach, especially with a president who put him in that chair expecting the opposite. And it's not just an American problem, by the way. Look at Japan right now. Their central bank, the Bank of Japan, has been raising rates too, worried about their own inflation creeping up. But Japan has a chart that should terrify anyone thinking rate hikes are a free lunch. Their economy, measured by GDP, is sitting at roughly the same size it was back in 1992, more than 30 years with almost no real growth. Meanwhile, the amount of money they've printed over that same period has roughly tripled. They've been trapped in a cycle of borrowing and printing for over 3 decades, with nothing to show for it in real growth terms. That's the cautionary tale sitting in the background while the US debates its own path. Printing and borrowing your way out doesn't actually fix the underlying problem. It just changes what kind of pain you feel and when. Now, hold on. You might be thinking, if the jobs market is genuinely weakening, shouldn't the Fed just cut rates to protect regular working people? Isn't holding rates high or raising them actively cruel to the economy right now? It's a fair question, and on the surface, it seems obviously right. Here's the problem with that logic, though. The Fed's mandate isn't just protect jobs, it's also protect the value of money. Those two goals are currently pulling in opposite directions, which is the definition of a stagflation trap. If they cut rates purely to help the job market and inflation reaccelerates because of the oil shock we talked about earlier, they risk a much worse outcome down the line. A currency that buys less, savings that erode faster, and a bond market that, as we covered, could push borrowing costs up anyway out of pure distrust. In other words, cutting now to feel better in the short term could make the eventual bill much larger. That's not a defense of raising rates into a weakening job market. It's genuinely a bad situation with no clean answer. But it explains why the Fed isn't behaving the way people expect a normal cycle to behave. Let's talk about who's actually positioning for this, because it's not retail investors and it's not the average person scrolling headlines. It's institutions, and specifically central banks. The World Gold Council just published their monthly data, and central banks added a net 41 tons of gold to their reserves in a single recent month. Poland has been buying aggressively, adding 18 tons that month alone, pushing their year-to-date total past 60 tons, closing in on a stated target of 700 tons in reserves. China's central bank just logged its 20th consecutive month of net gold buying, 20 months in a row without stopping, adding to reserves that now sit around 2,300 tons. Uzbekistan and Kazakhstan have both been steady buyers all year. Even Singapore, which hadn't been a net buyer since September of last year, jumped back in. And in their own survey of nearly 80 central banks worldwide, 89% said they expect global central bank gold reserves to keep growing over the next year, with a record number saying they expect their own institutions' holdings to increase. Now, think about that for a second. These are not retail investors panic buying gold coins off late night infomercials. These are the most sophisticated financial institutions on the planet, the ones with direct access to every piece of economic data before the public ever sees it. And they are quietly, consistently, month after month, accumulating gold. Not because they're trying to get rich. Central banks don't day trade. They're doing it because they're diversifying away from an over-reliance on any single currency, including, in some cases, the dollar itself. That's the smart money signal, and it's been running for years now, not weeks. I want to come back to that debt trap analogy for a second, because I think it's the clearest way to see the whole picture. Imagine you're holding a bathtub that's slowly filling with water. That's the national debt, always rising. There are two ways to deal with rising water. You can let some drain out the bottom, which is like paying down debt through real economic growth and discipline, or you can just keep adding a bigger tub, which is essentially printing more currency to cover the gap. For most of the last 20 years, the government has been building bigger and bigger tubs, rather than actually draining water. The problem is, a bigger tub doesn't mean less water. It just means the water is spread out and looks less alarming for a while, until people start noticing the room itself is flooding. That's currency debasement. It's not a dramatic crash. It's a slow, steady rise in the water level around everyone's ankles, felt every time you go to the grocery store and don't understand why the bill is higher than it should be for the same cart of food. Now, hold that image, because I'm going to come back to it. Let's break this down by asset, because this is where it actually gets practical for you. Start with stocks. The market has been remarkably resilient through all of this, near record highs, in fact. And part of the reason is that investors are betting the Fed will eventually be forced to print money and support the economy, no matter what. The same instinct we saw in past crises. That's a dangerous assumption to build a whole portfolio around, because it assumes the safety net always catches you, right up until the one time it doesn't. Stocks can absolutely keep climbing here, but they're increasingly climbing on hope for a rescue, rather than on clean underlying strength. And that's a different, more fragile kind of rally than people realize. Then there's gold. It's trading right around $4,100 an ounce as of today, up over 20% from where it was a year ago. Silver has actually outpaced it, up nearly 60% year over year, trading in the high 50s per ounce. That kind of move isn't random speculation. It's happening in lockstep with everything we just walked through. Sticky inflation, a Fed that's boxed in, foreign buyers stepping back from US debt, and central banks worldwide quietly diversifying their reserves. Gold has historically done exactly this in periods where trust in currency and government finances get shaky. It did it in the 70s, it's doing it again now. And then the dollar. This is the one people think about the least, but it's the thread tying everything together. Every dollar in your bank account, every dollar in a typical retirement account, is a claim on a currency whose issuer is running historic deficits, facing a debt interest bill that's ballooning, and dealing with a central bank that admits it can't fully control the inflation side of the equation right now. That doesn't mean the dollar collapses tomorrow. It means the water level in that bathtub keeps creeping up, quietly, while most people are focused on the day-to-day headlines, instead of the slow structural trend underneath them. So let me tie this all together, because I know that was a lot. A weak jobs report should normally mean lower rates and a relieved market. Instead, we got 57,000 jobs, a Fed openly discussing hikes instead of cuts, a bond market demanding higher yields out of distrust, a new Fed chair who was installed specifically to do the opposite of what he's now signaling, and a world of central banks that are voting with their actual reserves, not their public statements, by piling into gold month after month for years running. That's not a prediction of doom. Nobody on this channel is telling you the sky is falling by next Tuesday. What it is a genuinely unusual moment where the people who run the system are positioning defensively in real time. And the question is simply whether you're paying attention to what they're doing or just to what they're saying on television. If you've made it this far, I want to mention one more resource, because I think it matters more than any single video could. Beyond the free guide I mentioned earlier, we also host a completely free one-on-one educational web conference specifically for people who have $100,000 or more sitting in a retirement account and want an honest, no-pressure walkthrough of how moments like this, rate uncertainty, inflation pressure, a shifting Fed, actually affect a portfolio like theirs, and what real diversification looks like in practice. It's not a sales pitch dressed up as education. It's a conversation with someone who can actually answer your specific questions about your specific situation, because generic advice in a moment this unusual just isn't good enough anymore. There's a link below, or the same QR code on screen, if that's something you want to look into. Either way, I hope this gave you a clearer picture of what's actually happening behind the headline number, and why only 57,000 jobs somehow still didn't move the Fed toward relief. Keep watching the data, not the noise, and I hope you have a wonderful rest of your day.